I'm Martin McGrath from Financial Edge Group. We specialise in helping people with complex retirement situations get things sorted. Today, I just want to take you through a hopefully fairly simple kind of concept around the same income in different names can end up with a very different tax outcome. We've had some clients come to us recently and for various reasons have got some significant investment earnings in their names or structures. And in some of these cases, we've got the ability to move between structures where that money is invested. So what I want to try and talk a bit about today is the same investment income can end up with a very different tax outcome depending on where you're holding those investments. So before we start investing, let's start thinking about what is going to be the tax outcome of this, both in the short term and in the long term. So just for demonstration purposes, I put a scenario up behind me that I'm going to take you through now of around an investment portfolio making around $500,000 a year. Now, significant income. And so usually we probably need to have, we've got millions in this case to earn this kind of income, potentially 5, 10, 15, 20 million to earn this kind of income. So there's some different tax outcomes about how it all fits together. So let me try and talk you through that as best as possible. So let's say we've got $500,000 worth of income. There's potentially 4, and there's even more different tax outcomes about how this all fits together. Option A, if that person was a single person, they just left that in their own name, this is the tax they're going to be paying. They'll end up paying $201,000 worth of tax just on that income. That's assuming they have no other income. There's no extra capital gains. There's nothing else in that respect. So 200 grand in tax, the HO says, well, you get to keep the other 300. We'll take 201,000. Let's say that person was part of a couple. And it might sound simple, we'll find a partner, that's one way to solve it. Or often we go, I've got some money in my name, but my spouse doesn't have much income. Should I split some of that? The short answer is potentially yes. Same income in joint names, we're saving about $34,000 in tax there straight away, just by having that in 2 individuals' names rather than one. 201 goes down to 167. Most people understand that, individual name, joint names. But there are other structures we can be investing in. Number 3, or option C, inside of a company. So you can invest in company structures. I'm not saying running a business. You can run a business as well. I'm saying an investment company or a bucket company, often they're referred to. That company tax rate is at a 30% tax rate. I've got a separate video talking about a bit of a deep dive of bucket companies and investment companies, but it's a flat 30% tax rate. Whether you earn 500,000 or 5,000 or 50 million, we're paying 30%, which in this case ends up being 150,000. So there's already a $50,000 tax saving there. Plus the difference of this, and there are layers to this. This tax paid here creates what's called a franking credit or a tax credit that company potentially could use later. So it's not tax that's gone forever. It creates a bit of a tax credit that potentially could be helped to use to save some tax later. Option D is inside of an SMSF or your super. Either it's an SMSF or super. Super fund tax rates in accumulation are at 15%. So again, we can't just go and move $10 million in there. There are people who have those balances inside of super and larger. The tax they're paying is potentially that 15% tax threshold, which means that's $75,000. So you can see in the same income, same asset, different name, very different tax outcomes. And if you're down here, we're actually over 60 and in pension phase, that tax rate can reduce. Probably not the whole amount, but a portion of that could actually be taxed at 0, bringing that average tax rate down even further. Family trusts are another structure that could be incorporated in this. It's not a tax structure in itself or a tax rate as such, but it allows us to some flexibility between these tax rates, investing through a family trust. Again, I've got a separate video on family trusts and when they shouldn't be used. But it's kind of explained today, don't just start investing until we start to get some advice from someone who's qualified to give tax advice, like ourselves as financial planners, Financial Edge about business. All our financial advisors are authorised to give tax advice. As a business as well, we have a tax agent license. Myself, I'm a chartered accountant, so we understand a lot of this tax side of things. We take care of the investment side as well. But you can see here on the exact same tax income, we're talking about hundreds of thousands of dollars of potentially in 1 year, let alone the compounding effect over many years. So if you feel like you're paying too much tax and we've got some substantial complex affairs, it's definitely worthwhile and going, hey, should I be structuring some of this stuff differently? It might be that you've inherited a lot of money and just end up in your name. But it doesn't mean it has to stay there. So pause, let's get some advice. If you want to have a chat with myself or the team at Financial Edge Group, you can find us online on socials on the website, financialedgegroup.com.au, or in the socials, and we'll be more than happy to have a chat.